Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to investing and personal finance. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. But today I'm actually doing a collaboration with Investing with Frank. He is an Australian-based value investor whose channel goes over many topics as they relate to value investing. And he does a lot of stock breakdowns on his channel. They're very informative, very in-depth. Gets a lot into the numbers and the growth projections for companies, which are obviously very important considerations to make if you're going to invest in one. Definitely recommend checking out his channel if you're at all interested in stocks and value investing. But for today's video, Frank is going to be doing an analysis on Dropbox and its stock, Dropbox being the cloud-based storage company. He gives a lot of great insights into the company, which should serve as a useful foundation for any potential research that you might want to do after this. Because of course, this is not financial advice. If you end up liking this video, definitely check out Investing with Frank's channel, and while you're there, be sure to check out the other half of this collaboration where I did an analysis on Pershing Square Holdings, the hedge fund run by Bill Ackman. Be sure to check out the rest of Frank's stuff since it is top-notch. Anyways, I'll let Frank take it away.
Hey Jack, and thanks for having me on the channel. If you guys enjoy, don't forget to leave a comment and let us know, so maybe we can do more videos like this in the future. And if you haven't already checked out Jack's video on my channel, where he breaks down Pershing Square Holdings, don't forget to do that after you watch this video. But today I'm going to have a look at Dropbox. So let's jump right into it. Okay, so Dropbox is what I like to call the forgotten growth stock. As all these other tech companies have gone on huge runs over the past 5 years or so, Dropbox's share price has actually gone nowhere. You can see over the past year they have had 44% growth, but for a company that should have benefited from the pandemic, 44% isn't that much of an incline. Of course, shareholders aren't going to complain about such a great run-up, but it's not what you'd expect to see for other companies. And if we're looking over the past 3 years since inception, the share price has actually gone down. So overall, for a company that has been growing as well as Dropbox, the price really hasn't gone anywhere. If you're not familiar with Dropbox, I'll just give you the quick breakdown. The market cap is about 11 billion. And they're essentially a collaboration platform. It's gone beyond just a storage system that most people probably think of as Dropbox. And most people are concerned with the competitors such as Google and Microsoft, who have entered with their own platforms like Google Drive or OneDrive. However, they've kind of expanded beyond that. And there's also some competitive advantages that they have even just within that storage service that they provide to users. But we'll break down that a little bit further in the video. Firstly, if we jump across into the financials, I just wanted to show you some of the growth that Dropbox has seen. So I'll take this back to 2015. You can see over the past 5 years, revenues have grown 40%, 30%, 25%, 20%, and 15%. So super solid growth that has somewhat slowed down, which might be part of the concern of the market. However, it's the bottom lines that have been moving a little bit more and somewhat unrecognized. So they haven't been profitable until the most recent reporting period, and that's only on an EBIT basis or operating income. They just reach profitability as they start to improve their margins. You can see how much their gross margins have improved over time, which is super impressive. Now they're starting to minimize some of these SG&A costs. They're going to minimize their R&D expenses, and you will see this operating leverage start to kick in. It hasn't quite transferred to the bottom line. It would have, but they had a recent asset write-down. But moving forward, you can expect to see profitability soon, and I think that might be somewhat of a catalyst for the market. I'll quickly touch on this now, and I'll touch on it again later in the video. This is their shares outstanding. So they have been diluting shares. It's somewhat slowed down over the past year, but this is one of the most concerning aspects of the Dropbox thesis. I personally am not a shareholder. It is towards the top of my watch list, but this is one of the main reasons holding me back. So it's something to follow closely if you are interested in the company. Now, I'll jump back into some more financials later, but first I want to show you quickly the write-up I have done on my website. So I'll give this link to Jack and he might put this in the description for you if you're interested. But I just break down a real rough thesis around Dropbox. I don't go into a lot of detail of this, but it might be a good starting point for you. So I talk about the cloud-based storage. They have over 600 million registered users, and that's an important part of this thesis because not all of those users are paying, but of course they are users, so it's something that Dropbox can focus on if they want to improve their revenue, both top line and move that down to the bottom line as well in the future. Of course, the cost to move these existing users into paying users, they don't have to use as much marketing as they would for people that aren't already on the platform. So it's a cheap way to improve that bottom line. Now, the company was founded or co-founded by Drew Houston in 2007. He originally wanted to acquire Slack that I thought was very interesting for $1 billion. And that's going back a fair few years now, and it's now just sold for $28 billion. So he did recognize these opportunities in the market, which speaks to his forward-thinking visions and the way he's trying to manage his own company. I'll just quickly note that this part here is irrelevant now. They did hire a former Google Cloud VP, but she has since left the company for a different opportunity. Now let's talk about some of the value opportunities. So they've compounded their revenue annually at 20% since listing on the NASDAQ. We showed that just briefly before, but it's worth noting that that is really impressive numbers. I also briefly mentioned this 600 million users. Only 20 million of those are paying users. That's not a lot of improvements they can make. Even if they just double this number to 40 million, that's a huge amount of extra revenue with not much cost to actually do that. So there's a lot of value opportunities in their existing ecosystem. One of my favorite things about Dropbox is their margin expansion opportunities. So I talked about that briefly, but this table breaks it down and gives you the guidance that management has provided. So they've finally reached their gross margins, or they're almost at their target of 78 to 80%. So we can expect a little bit of expansion there. They're going to minimize their R&D expense from 30 down to about 25. Their sales and marketing from 23% down to about 20. G&A down to 10%. And that brings our operating margin from 12% all the way up to almost 30%. So that is really impressive. And if those numbers do come into fruition, I think you will see the share price start to recognize that pretty quickly. Considering they're not profitable now with these type of margins, I think that growth gets recognized a lot quicker when it's backed up by a solid margin expansion over time. They've also given an annual free cash flow number of $1 billion as their long-term target, which is an important number for when we move towards a valuation. So assuming that they can reach that cash flow number by 2024, which management has indicated they can do so, that's compounding the free cash flow an impressive 20%. That is really solid growth, and if that is the case, I think definitely investors will start to recognize this and the share price will start to move. So currently they're trading about 5 times sales. For a company with such high growth in the industry that it's in, 5 times sales is extremely cheap. And then we also have this 18 times free cash flow, which is definitely cheap as well. But if we're looking on a forward basis of these 2024 targets and the margin expansion that we're going to see, that's actually 6 times free cash flow and 12 times EBITDA, which is starting to look more like a deep value stock, which is super surprising for a company like this. But let's jump into some of the risks. So one of the co-founders has since sold his shares. However, he was kind of just there for funds originally. It wasn't his idea. Drew Houston was the one that came up with the Dropbox theory, and he is still there. So that's important to note as well. But it's worth considering that one co-founder has left the company. The competition that I talked about briefly. So we have Google with Google Drive and Microsoft with OneDrive. And then we have other things like Slack and Microsoft Teams when they move towards that workplace collaboration. So they're doing all that now with all the digital signatures and things like that. They're being more than just a cloud storage system. So of course we have these big competitors in the space. However, they've been there a long time now, and Dropbox hasn't gone anywhere. The growth has continued. But it's important to consider with players with a lot of capital in the space, that is one of the main risk factors. And I think that's probably the main reason shareholders have stayed away, just because of that concern. But the longer it goes on and the longer Dropbox stays strong and continuing to improve and expand what they're doing, it shows just how much of a competitive advantage they have. Now, the main concern is the dilution that they've been trying to set off with a buyback program. Buyback program is great, but when it's only to offset the dilution, that's somewhat concerning. It's better than just ignoring the dilution for sure, but preferably we'd want to see this dilution stop. And it's from a stock-based compensation, mostly. They have raised capital as well, but mostly from a stock-based compensation. And it's not unique to Dropbox. Most of other tech competitors have similar stock-based compensation. So it is reoccurring in the industry, but it's definitely one of the main problems. So when we're thinking about some of these growth numbers, we have to remember that's been offset by dilution. So if they do compound their free cash flow at 20%, like we talked about, if dilution is occurring at about 3% or something like that, that seems very possible, then we're only looking at a 17% free cash flow growth number. So that's where the downfall in this investment is. If management stop diluting shares so much, it immediately becomes super appealing, in my opinion. Now that's all for my write-up. If you want to go read that, feel free. It is just a very brief summary. There is another couple of write-ups I wanted to share with you. I won't go into too much detail, just wanted to show you they exist, and maybe Jack can leave these linked down below as well. So this one's written by Gary Alexander on Seeking Alpha. He talks about 4 times forward revenue number. He talks about a $1 billion stock repurchase plan. Again, that is a great thing, and it's going to drop off 10% worth of the current market cap, and it kind of stabilizes the share price. However, I will note that that is partly to offset the stock-based compensation dilution. Another write-up you can go and check out is from about a year ago, from Value Investors Club, written by a user called Martin92. And he talks about some of the ideas that we've talked about and lays out some of the numbers in more detail from you. And talks about some of the competitors and how he's not so concerned by that, and some of this margin expansion, which again is probably one of the main appeals for the company. But overall, in a nutshell, that is the Dropbox thesis. It's a super interesting company. Like I said, I definitely think it is a growth stock that got left behind. There is opportunity there. You can see some of the market sentiment around this is negative. There's a little bit of short interest, not extremely high, but worth noting that some people are willing to short the company. So as the next step in your research, you might want to find out in more detail why that is. Partly, I would say it's because of the competition they're facing, even though in my opinion, they have held up pretty strong. And then things like the stock-based compensation program that we talked about as well might be part of the reason some people are shorting. But that's it for today's video, guys. I hope you enjoyed. Thanks again, Jack, for having me on the channel. I really appreciate it.
Thanks for that, Frank, and thanks for doing this collaboration. Like I said earlier, be sure to check out Investing with Frank's channel. You can actually go see the other half of this collaboration where I did my breakdown in Pershing Square Holdings. So if you're at all interested in that, be sure to check that out and look at his other content as well, since it is really good stuff. But otherwise, it's all I've got for today. Be sure to like this video, subscribe, comment, all that good stuff. And until next time, take care.